Gold just did it again. It broke another all-time high, and now it's pulling back. Despite this though, it's been this cycle's best performing asset by far, and everyone's calling it the ultimate safe haven asset. But here's what they're missing. There's a pattern between Bitcoin and gold, a pattern that's repeated every single cycle. Here's how it plays out. First, gold runs, and while gold's making the headlines, Bitcoin quietly starts building momentum. And then as soon as gold consolidates, that's when Bitcoin makes an explosive move. And this isn't a theory. It's a pattern that's played out over and over and over again. And now if you look very deep, it's playing out right in front of our eyes. Because gold's just made it an all-time high, and it's starting to consolidate. And now it's Bitcoin's chance to explode. I have the data, and let me tell you that what I found is absolutely insane. Two completely different models, both pointing to exactly the same price target. And that price target is much higher than where Bitcoin's trading today. Much. One of the model tracks Bitcoin's lag to gold, and the other one tracks its market cap ratio. And both models point to the exact same fair valuation target for Bitcoin. I'm going to reveal that target at the end of the video. Also, earlier when I was making this video, I found another model, completely unrelated to gold. But believe it or not, the model that's unrelated to gold gave me exactly the same price target. That's three models pointing at exactly the same price target. I'm 𝗕𝗘𝗪𝗏, and I love sharing videos and frameworks like this that are designed to make people just like you achieve financial freedom. Every day, all I do is I analyze the data and I connect the dots, and then I share this all on this channel before the market catches on. And right now, everything's pointing to one clear data-backed conclusion about where Bitcoin's about to go next. So stay tuned and hit the like button if you haven't already hit it, and subscribe to the channel if you're not already a subscriber. First, let's talk about gold's insane rally.
What a momentum trade for the yellow metal. Gold has now risen over 20.
As of right now, gold is trading at levels we've never seen before. It peaked at about $4,400 on October 17, and that's up over 62% in 2025. Now, for an asset class that's the size of gold, a move like this is absolutely insane. Its total market cap smashed through $30 trillion, and it now represents about 12% of the world's total investable assets. Also, if you look at the gold buyers, these aren't a bunch of retail guys that are speculating. These buyers, these numbers, they're being fueled by central banks. Those are the guys that print the money. In 2025 alone, they've been buying at a record pace. Poland, China, Turkey, they're all diversifying out of the US dollar and into hard assets they can trust. And while they're doing this, they're creating a structural floor on the price of gold. Now, these guys don't speculate. These guys accumulate. And they're all making the same bet right now. So why? Why are central banks and investors all running into gold at such a pace? Well, that brings me to my next point. It's called the debasement trade. It's the most fundamental concept that you need to understand. When countries devalue their currencies, gold reacts immediately. It's the oldest and most trusted hedge against fiat currency devaluation. And it's been like that for centuries. I mean, just going back to the 2000 dot-com bubble, the S&P dropped by 50%, and the Fed had to step in to save Wall Street. So what did they do? Well, they cut rates and they injected liquidity. And what did that do? It caused the US dollar to weaken. And so what did gold do? It jumped 55%. Then again in 2007, 2008, when the financial crisis happened.
The NASDAQ, everything and more has been completely wiped out.
The worst day on Wall Street since the crash of 1980.
Everyone was fearful. Everyone was running into the safe haven assets. The S&P fell by 57%. What did the Fed have to do again? They had to print a lot of money and input this liquidity to save the market. So people were scared around the debasement. And what did they do? They ran into gold. And gold went up 60% in the same period. Then again in March 2020 when COVID hit.
Tonight, I want to speak with you about our nation's unprecedented response to the coronavirus outbreak.
The world went into lockdown, markets collapsed, liquidity evaporated. And what did the governments do? They started printing trillions of dollars to keep the economies alive. That was effectively a wave of currency debasement. And that stimulus weakened the real value of money. And so what did gold do? Well, within weeks, gold dropped from $1,400 to over $2,000 an ounce. It did this because investors were fleeing from risk into hard assets. And then again in March 2023, when Silicon Valley Bank collapsed and the US banking system all came under stress, what did gold do? Gold surged nearly 15% in just a few weeks. That fear wasn't just about the banks. It was a complete loss of trust in the system. And that's the thing. Every bailout, every liquidity injection means more and more money being put into the economy, and ultimately that means debasement. Let's fast forward to 2025. Global trade tensions are back. Tariffs are rising. And what are governments doing? They're spending aggressively to defend their economies. This time, it's not just inflation driving gold. It's actually the debasement or the devaluation of currencies. I mean, just look at Trump. Trump wants lower rates and a weaker dollar. That's debasement right there. And it's not only Trump. I mean, look at Japan. They've just elected a new female prime minister. And what does she want? She wants lower taxes, more money printing, and ultimately that's debasement. When global investors see countries running deficits, cutting rates, printing money to cover spending, they start dumping their fiat currencies. And when they do, they move into hard assets like gold. And that's happening right now. Countries are quietly diversifying from the US dollar. They are de-dollarizing their reserves, and they're loading up on gold. Central banks now own more gold than US treasuries. That's the first time that's happened in 30 years. It's the ultimate vote of no confidence in the fiat money system. And so against this background, gold is going parabolic. And that's why it's up over 62% this year. It's even gone from $3,000 to $4,200 in just a few months. And here's the key. This isn't about inflation anymore. It's about debasement. It's about the fear that governments will print and spend their way out of every problem, because that's what they've done in the past. They'll keep doing this until their currencies eventually become worthless. Now, Bitcoin is fundamentally the same hedge. And recently, Wall Street has started to accept that. Finally, Bitcoin is becoming digital gold. And you can see it in the flows. This year, the gold ETFs had an inflow of $64 billion. That's compared to only $3 billion total inflows last year. At the same time, central banks have been buying gold like crazy. Just in the past 2 quarters, central banks have bought over 410 tons of gold. For the first time since 1996, central banks hold more gold than treasuries in their reserves. And gold makes up over 20% of the total reserves, while treasuries and US-related investments have dropped to below 23%. Right now, though, central banks can't buy Bitcoin yet. But corporations can, and ETFs can, and they are. While central banks were buying physical gold, US spot Bitcoin ETFs also absorbed $25 billion of inflows this year. In the first week of October alone, they pulled in $3.2 billion. Look at the BlackRock ETF. It now owns over $100 billion in assets, and it's the fastest growing ETF in history. So what does this mean? It's not a rotation. It's an expansion. The same liquidity, the same debasement fears that pushed people to gold are now pouring into Bitcoin. And you can see it when you look at the ETFs. The institutional fire hose has been plugged in. Gold just got there first because it was the legacy asset. But the institutions are actually buying both gold and Bitcoin for exactly the same reason: And here's the craziest part. While the institutional tidal wave is happening, the market is actually terrified. I mean, the fear and greed is sitting around 25 at extreme fear. Bitcoin is only 15% away from its all-time high, and the retail sentiment is in the gutter, probably because of the flash crash that we had and the war news and everything else. This is the ultimate setup. This is the diversion between smart money action and retail sentiment. And this kind of divergence is what creates a life-changing opportunity. And I'm making this video now because I think I'm seeing one of those life-changing opportunities. Just look at this 60 to 90 day lag model. This isn't a theory, it's history, it's data. Just look at how the data backs this up. Gold and Bitcoin move together. The only difference is the magnitude and the timing. The data shows that gold makes the move first and Bitcoin follows 60 to 100 days later. The same data also shows that Bitcoin amplifies gold's move. In other words, it moves more than gold moves. And you can see it perfectly in the data from 2020. Gold started its run in April and it peaked at over $2,000 an ounce in August. Now let's look at Bitcoin. When gold started its run, what was Bitcoin doing? Nothing. Literally nothing. It sat between $11,000 and $12,000 for months. Then when gold started to consolidate 60 to 70 days later, that's when Bitcoin began its historic rally from $11,000 to over $60,000. And again in 2024, when gold started rallying from $2,200 to $2,800. Bitcoin had been consolidating between $55,000 to $65,000. And when gold finished its move, well, that's when Bitcoin started to move. And it moved from $65,000 to $108,000. So what's happening right now? If we apply the same 60 to 100 day lag between Bitcoin and gold, that puts Bitcoin's next move somewhere between mid to end December. And that's much sooner than you think. And if the magnitude is even remotely similar, based on this lag model, Bitcoin's projected fair value lands at $157,000. This model tracks gold's movement and pushes it forward by between 60 and 80 days to forecast Bitcoin's movement. And it projects a Bitcoin price between $156,000 and $157,000. That's sexy, right? But now for the other valuation model. Let's test it with raw valuation data and see if the maths tallies up. Gold's market cap is $30 trillion. And at these prices, Bitcoin's market cap is sitting at about $2.1 trillion. That means that Bitcoin is only 7% of gold's total value. But here's the context that most people miss, right? Let's rewind to the previous cycle. At Bitcoin's peak in 2021, when Bitcoin hit $69,000, its market cap was about 11% of gold's total market cap. Then during the 2022 bear market, when Bitcoin dropped, it dropped to about 3% of gold's value. So we've already seen both ends of the spectrum. At the bottom range, it's 3%, and at the top range, it's 11%. But this was before the ETFs. This was before the market accepted Bitcoin. This was before the market said that Bitcoin was digital gold. Today, Bitcoin's sitting at around 7% of gold's total market cap. And that's just in the middle of that historic range. So even if Bitcoin just returns to the same relative value it reached in 2021, i.e. 11% of gold's market cap, at a $30 trillion valuation, that alone implies a Bitcoin price of, well, you guessed it, $157,000. But here's where it gets interesting. Since 2021, we've seen a huge wave of Bitcoin adoption. We've got the institutions, we've got sovereign interest, we've got corporations, all accepting Bitcoin as an investable asset. We've even got some governments holding Bitcoin on their balance sheet.
Next week, I will send to Congress a bill that will make Bitcoin a legal tender in El Salvador.
So it's fair to assume that Bitcoin should now represent a higher percentage of gold's total market cap. If we just assume that that percentage goes up to, say, 20% of gold's market cap, well, that puts Bitcoin at closer to $285,000 per coin. And that's probably our bull case. But for now, let's stay conservative. let's stick to the base case data and say that Bitcoin's fair value is $157,000. And here's the crazy part. That $157,000 valuation isn't random. It's the exact same figure that the 60 to 90 day lag model predicted. Two completely different frameworks, two completely different models, both landing up at the exact same price target. But wait, here's where it gets even crazier. Remember I told you that I found a third model that confirmed exactly the same target? Well, there's a third model, and this one has nothing to do with gold. In fact, it has to do with the NASDAQ, with risk assets. When you compare Bitcoin to the NASDAQ, which it's been very highly correlated with since 2020, the data shows that Bitcoin is currently trading at about a 31% discount to its fairly implied NASDAQ valuation. This model has tracked Bitcoin for the past 5 years, and they applied the same log linear regression to see where Bitcoin's price is mispriced against equities. And that model? Well, you guessed it. It implies a fair value of exactly $157,000. So now we've got 3 separate data points, 3 different models, all correlating for the same thing. The gold price lag model, the market cap ratio model, and one that doesn't even look at gold and just talks about equities. And they all point to exactly the same price. That's not a coincidence. That's more of a confirmation. More of a confirmation that $157,000 may be the fair value right now. And that would be conservative because, as I said, back in 2021, the Bitcoin adoption was nowhere near where it was today. In 2021, there weren't even spot ETFs, let alone sovereign interest. Today, Bitcoin's been accepted as a safe haven by investors. We have institutional infrastructures, we have regulated ETFs, we have governments promoting Bitcoin.
This afternoon, I'm laying out my plan to ensure that the United States will be the crypto capital of the planet and the Bitcoin superpower of the world.
The foundation is much stronger, and the signal is even clearer. Gold's already made its move. Bitcoin hasn't. And every single cycle, gold lights up the path, and as soon as gold consolidates, that's when Bitcoin explodes. But this time, this explosion, it's going to be backed by institutional infrastructure, by ETFs, by corporate balance sheets, by treasury companies, and by a much, much, much larger force. And the gap between gold and Bitcoin is bigger than it's ever been before. Both models, the timing model and the valuation model, both point to exactly the same outcome. Bitcoin's fair, conservative value sits at $157,000. It's not a guess, it's not hopium, it's just history, data, and macro structure alignment. Gold's rally and consolidation isn't the end of the trade. It's a signal that Bitcoin may be next. And if I'm right, this is coming soon, sometime before mid to end December. If this video gave you a clearer picture of what's coming next, obliterate the like button, subscribe to the channel, and I'll see you on the next video. Until then, let me know in the comments what you think of the analysis, and trade well, my friends.